Hello everybody, I'm John, this is JP Strategic Investments, and today we're talking about gamma squeezes. Everything from how to identify when a gamma squeeze is happening to navigating one, whether you're a long-term investor trying to manage your position through a gamma squeeze, or whether you're a trader trying to actually trade and take advantage of the gamma squeeze. And then finally, what happens when a gamma squeeze ends, how far is the stock likely to drop, and everything around that. So I'm going to try to keep this as short and sweet as possible. So let's jump right into it here. Now, the first thing that we need to know, obviously, is what is a gamma squeeze and how it works. And there are a lot of great videos on YouTube that go into detail, so I'm not going to spend too much time on this, but I do want to give you guys kind of the 1-minute description. Now, the first thing that you need with a gamma squeeze is usually a lot of options activity, usually call options, but a gamma squeezes can actually happen to the downside as well. And keep in mind, institutions and market makers are usually the ones selling these options. That's important because we'll get back to that in a second. The next thing that you usually need is some sort of catalyst, usually a fundamental thing, news that comes out about a stock, for example, Tesla announcing a stock split or crushing delivery numbers or something like that. That gets the stock moving, gives it some momentum, and really kicks off the gamma squeeze. Now, the next thing, let's get back to those institutions and market makers selling those options. When these institutions and market makers are selling call options, let's just stick with call options for a second, they need to kind of hedge their position. They like to remain what's called delta neutral. So what that means is they don't like to be overly exposed to a stock making larger moves. This means that if they're selling call options, they need to actually buy some shares of that same stock in order to kind of hedge their position. And the thing is, and this is where we get into the gamma in gamma squeeze, is that when a stock rises, the rate at which a call option increases in value actually increases, or it gets quicker. So let's say, for example, if a stock is here, institutions and market makers, to hedge the calls that they've currently sold, may have to buy 1 million shares of the stock. But if the stock moves up to here, then they might have to buy 2 million to hedge those same options, because the rate at which those options are increasing in value, or in other words, the rate that those institutions are losing money on those options if the stock goes up, has increased. This means they need to buy more shares to hedge. This buying of shares puts upward pressure on the stock, which pushes the stock up even higher and forces them to buy more shares, and so on and so on. And that is, in a nutshell, a gamma squeeze. Now, the kicker here, especially with stocks like Tesla and other stocks that have a lot of retail investors in them, is a lot of times when good news like this comes out, let's say they crush delivery numbers, even more investors will buy call options. And now not only are the institutions and market makers having to hedge the options they've currently sold, but they're having to hedge all of the new options that are being bought. And this can really push a gamma squeeze even higher. So that is kind of what a gamma squeeze is and how it works. Now let's get into the first thing here, how to actually identify a gamma squeeze. Now, keep in mind, in order for a gamma squeeze to happen, we need a stock with a lot of options activity. And the way that you check this, what you want to keep an eye on is open interest. You can look at that pretty much on any platform you're using, any brokerage you have. You can check the open interest, and what you usually want to do is check the open interest at key levels on the monthly call options. And what I mean by that, the monthly call options would be the third Friday of every month. Those options expiring on the third Friday of every month, generally referred to as the monthlies. Those options you want to check at the key level. So with Tesla, for example, right now Tesla's trading at about $1,100, just under $1,100 a share. What I mean by key levels is you'd probably want to check the $1,100, $1,200, $1,300, maybe even $1,500, and see what kind of open interest you're seeing there. Usually you want high thousands to even 10,000s on those open interests there for a stock to really be susceptible to a gamma squeeze. Now, the next thing, remember, is we need a catalyst, right? We need some sort of fundamental thing that is sparking this gamma squeeze, that starts pushing the stock up dramatically. So again, that could be something like Tesla beating delivery numbers, could be something like an earnings report, anything like that that kind of gets the stock moving, gives it some momentum. So once you see that momentum start to build, you want to start to keep an eye on that open interest. Okay, is that open interest still high? Or if you haven't checked that open interest, maybe you see that spark in a stock, check that open interest, see what's happening. And the last thing here is you want to see the stock consistently moving higher, because Remember, a gamma squeeze can last one day or it can last several days, right? It really just depends on the stock, depends on how many people are buying call options, how many people are taking profits on those call options, etc. That's one of the reasons why with Tesla stock in particular, a gamma squeeze for Tesla stock could last actually several days, because a lot of times the investors who are buying those call options think the stock is going to go much, much higher. And so even if the stock moves up 4 or 5% in a day, they'll hold on to that option and keep going. So again, what we're looking for with the gamma squeeze, and we're kind of sticking with call options here, but the same could be said for puts, is you want a lot of options activity and you want a catalyst that's kind of propelling the stock forward, and you want to see that stock consistently move up, either over the course of a day if you're trying to really day trade or do something like that, or over the course of several days. Just kind of depends on the situation. So that is kind of the basics of identifying a gamma squeeze. So let's say that we think a gamma squeeze is happening. What's the next step? How do we navigate this gamma squeeze? Well, if you're a long-term investor, my personal opinion, if you're long-term investing in a stock, you have a 2, 3, 5-year bullish thesis for the stock, I wouldn't mess around with a gamma squeeze. I just ride it out. If it makes you a profit in the end, it makes you a profit. If the stock moves up significantly and you want to trim your position a little bit, by all means, you can do that. You do have to manage your portfolio, right? You may not want one stock to become over a certain percentage of your portfolio. And so if you have to do that, do that. But for the most part, I would say if I'm long-term on a stock and a gamma squeeze is going on, unless I really want to trade it as well, I'm generally staying out of it. Now, if you are a short-term trader, if you're a momentum trader, day trader, etc., and you want to take advantage of a gamma squeeze, well, there are several different ways you can do it. You can buy calls, you can buy shares, you can do a variety of things. Now, there's a couple things to keep in mind with a gamma squeeze that may make some strategies better than others. First of all, with a gamma squeeze, generally you're seeing a lot of volatility in a stock. You're seeing a lot of momentum, which can make options more expensive. So buying calls, unless you got in before the gamma squeeze happened, may not be the best strategy, but it can definitely work, especially if the gamma squeeze is lasting multiple days. But another strategy that you can use that is a little limited as far as the stocks that you can use it on, but in my opinion is a better strategy with a gamma squeeze, is a covered call. And again, with a covered call, you need to have enough money to buy 100 shares. And obviously with stocks like Tesla that have high share prices, unless you have a lot of money in your portfolio, you probably can't buy the full 100 shares. But for other stocks that may be trading at $10, $20, or $50, depending on your portfolio size, those might be good targets. And the reason I say a covered call is a great strategy is because you still get to take advantage of the rising stock price with the 100 shares, but you also take advantage of the high premiums for the call options. And so, a stock that's trading at $20 a share, maybe you buy the 100 shares and you sell a $22 call, right? Or a $25 call, depending on how much you can get for those premiums. You could actually make money on the call and the shares depending on where the stock goes. And it's a nice hedge. If the gamma squeeze starts to end, you still have kind of that buffer with the call that you sold against your share. So that's kind of what I would do, probably my favorite strategy with a gamma squeeze if I'm going to trade it. But again, there are limitations as to which stocks you might be able to use it on. Now, if you do decide to trade a gamma squeeze, there are a couple things that you should keep in mind. First, you want to keep an eye on that open interest. If that open interest starts to decline, that could be a sign that the gamma squeeze is fading. So keep an eye on that. The other thing you want to keep an eye on is the key technical levels within the stock, right? Levels of support and resistance on the chart. Because after that initial bump from the fundamental catalyst, the stock usually starts to trade more on its technicals. And so what you want to do is keep an eye on key resistance levels that the stock might be getting close to, because those are points where the gamma squeeze might start to fade and points where you might start to look at taking profits. So keep an eye on those when you are trading if you do decide to trade a gamma squeeze. And lastly, how do we know when it's going to end? What happens when it ends? How far is the stock going to drop? Things like that. Well, first of all, what happens when a gamma squeeze ends is you have options traders taking profits, meaning they're closing out those contracts. And When those contracts get closed, those institutions and market makers that bought the shares to hedge against the contract they sold no longer have to keep those shares, and so they sell them. All those shares being sold puts downward pressure on the stock, and the stock tends to drop pretty significantly as a gamma squeeze ends. So, what do you want to keep an eye on? Changes in open interest. You want to be watching again to see if that open interest is starting to fade back to normal levels. That is definitely a sign that the gamma squeeze is ending. Again, the other thing you want to keep an eye on is technical levels, because just as when a stock is starting to approach resistance, that could be an area where the gamma squeeze is going to start to fade. What we want to look at as far as where the stock might bottom after a gamma squeeze is key levels of support, because that's where stock tends to gravitate towards after a gamma squeeze or as a gamma squeeze is ending, are those kind of key levels of support, whether horizontal or angled, whatever you're looking at with whatever stock you are trading. So that is kind of the basics here as far as how to identify a gamma squeeze, what ways you can possibly trade it, how to navigate it, and then as far as when it is ending, what you might want to look at and how far the stock might drop. If you found this video helpful, definitely hit that like button and consider subscribing for more videos like this. Other than that, I will see you guys next time and have a great day.